If you never did trading before, you must know that there are a few parts and steps to the activity of trading. The first part of the activity of trading would be to do your analysis, to look at the charts and to analyze the market. Then another step, it would be to execute the transaction. And this means to go into your broker's platform or the trading software that you use and click the buy or the sell button to enter a trade, and then add your stop loss and your take profit points. And as a part of this trading execution and trading in general, there is a big step called trading management or risk management, if you want, or money management. All of those combine would protect your account and protect your money, because if you risk too much on a trade and it happens that trade goes against you and you lose a big part of your trading account, that would be very painful and it's going to be difficult to recover. And in this video I would like to show you how to calculate the risk on your trading while simulating a transaction or a trade setup from A to Z. So in here, let's assume we have this moving average. So this is an indicator, and we are going to see how we are going to use this on the strategy. And this blue line represents the price moving around the chart. So the price sits here under the moving average. We are watching the price, and then we see it moving. So let's say that in this moment we checked all the rules and we have a buy signal. The next step that you would do in the moment where you have a buy signal is to decide where it would be the stop loss placement, this red line here on the screen, and the take profit placement, the blue line here on the screen. And we are going to see later what decides the take profit and also what decides the stop loss. And those are important because the stop loss and the take profit would decide your risk to reward ratio. So in this moment we can calculate the risk, how much money we are going to lose if the transaction it happens to go against us. And also we can have an idea about the reward that we are going to have, even if in many cases this would be seen later if we use a exit indicator. Then let's say that the market goes our way, and at this moment here the take profit rules are being fulfilled, so we close the transaction on a profit. Even if the market continues to go higher, we do not care about that because we respected our rules and our strategy and we made some profit. And in this case you can see only by looking at the screen that the reward is 2 times bigger than the risk, even if this is a crude depiction, but this is what you want. You want the rewards to be bigger than the risk, so that would cover in time, that would cover any losing trade. And next, let's see how do you calculate your risk, how do you calculate your stop loss. Let's say that you have an account size of $1,700 and you decide, you need to decide the risk that you are going to have per trade, how much of this account you are going to risk. So that could be 1% if you have a bigger account, can be 2%. If you get a little more experience, it could be even 3%, or if the account is very small, I've seen people that also would risk 5% of their account. But that's already too big. You need to understand that 5% means that if you lose 20 trades, your account is gone. If you risk 1% of your account and you lose 100 trades, your account will be gone. In this case, at 2%, we have 50 trades, but it's important that we build a strategy that it's a winning strategy and has a high win rate. So this means that you win more transaction than you lose, And also the transactions that you win, they are several times bigger than the risk, because every time you lose only 2%, but when you win you can make 4, 5, even 10% you can make. So those winnings in time will cover all the losses. In this case, 2% means $34 from 1700. And when we have a buy signal, let's assume that the entry price of that asset is represented by the number 4360. This is the entry price. So this is the number that you input in your broker's platform. And next, we need to set our stop loss. So you do that by analysis on the chart. And let's assume that the stop loss is at under the market price, of course, at the level 4344. So from the entry price to your stop loss, you have 16 points. So that's your risk, that's your stop loss, 16 points. Later, we will see that the take profit, it's at 4404. So that means 44 points. So this transaction, if you win, it will bring you 44 points. And if you lose 16 points. Then we take the risk. So 2% from our account is $34. And we divide, this is the amount of dollars that we would like to risk per transaction. So we take that and we divide it by the 16 points on the stop loss, and we get an amount of $2.125 per point. This is what we are going to risk in this transaction. So we are going to risk $2.125 per point. And if the take profit is 44 points, it means that the take profit would be 44 points multiplied by $2.125 that we have from here. And it's going to be $93.5. This is going to be the win. So in this transaction, if we lose $34, but if we win, we make 93.5. Of course, not all the transactions will be winning transactions. Some of them, they would be losing transactions. That's why we have a stop loss. So you should never trade the market without a stop loss, because if the price goes, it will continue to go down. It can just wipe your account, so it will take all your money. So you should always have a stop loss. You should always calculate it exactly as I shown you in this video. You can go back in the video and take those notes and study them, because at the beginning they will seem a little confusing. It will seem a little like it's mathematics, but it's very, very simple. If you do it a few times, you will see that it's not that difficult. Also, there are many broker platforms where they will show you, they will convert the money in points for you. So they will show you exactly the amount of money you would lose and the amount of money you would make.